Hello everyone and welcome to the second ever episode on the Magnus Capital YouTube channel. Today we're going to be covering a full extensive breakdown on the crash that took place last week on Friday regarding crypto and stocks and everything that was surrounding it, the insiders that took place and essentially what happened, how it all happened, and just giving you the full breakdown. So what will we be covering in this video? Well, we'll be covering the timeline leading up to the event, including the running shorts that clearly had prior knowledge of what was going to take place. Leading on from this, we're also going to be covering how insiders managed to pull off the largest single crypto liquidation event in history and how this all sort of ties into the phantom money argument with market makers and how they kind of prop up a lot of altcoin books with fake liquidity and how a lot of the market really is just leveraged from perp positions. So what exactly happened? Well, using CoinGlass, which is typically in the industry one of the most trustworthy sources for aggregated data, we can see that this was the largest liquidation event in crypto history. As this was published on last Saturday after the event, in the last 24 hours, over 1.6 million traders were liquidated with a total liquidation amount of over $19 billion. However, what they go on to say is also true that a lot of exchanges tend to kind of understate the liquidation reporting, so the likely was definitely much higher, especially with the magnitude and speed that this liquidation event happened. As we can see from the daily high to the daily low, Bitcoin itself dropped over 17%. However, if we scale down onto the lower time frames, you can really get a grasp of the kind of manipulation that happened, right? So if we check out the 15-minute chart here for the day of the event, right, so with New York market opening around 2:30 GMT, we can see that it more or less marked the daily high during pre-market. Now, as we can see, New York session closes around 9 p.m. Price was trading down, which we'll get into later. Market closed, and then bang, the move happened. So before we get into it, we need to figure out why did it happen? Who wanted the market to go down and why did they want it to go down? Well, to start with, we believe it was clear manipulation from Donald Trump and his insiders, whether that be the trading team he's got going for insider trading since he came into the White House, whether it be CZ from Binance or other heads of exchanges, whether it be other people who would have had a vested interest in this happening, such as market makers like Wintermute. But Trump was using tariff headlines to dictate the market that day. That's what we know. As soon as New York opened, that marked the daily high, and TradFi just nuked since then, as Trump was kind of playing off the whole starting a trade war with China, giving out tariffs, but he didn't specify a percentage. However, towards the end of the day, just before the daily candle and weekly candle closed, he slammed 100% tariffs on China. This meant that as the market closed, traditional finance could no longer trade and would be trapped into waiting until Monday New York session opened. Furthermore, we believe the reason it kind of happened is that there was too much retail leverage or froth in the system due to the availability of perps. Bitcoin is becoming a government level game, and well, what do we mean by this? Well, we mean that this market is no longer PvP, right? It's no longer you versus me in the order books. We've now got institutions having their hand in the market. There's so many available products to them, whether it's ETFs, you can buy Bitcoin backed stocks such as MicroStrategy. Then you've got DATs, so you've got people like Tom Saylor that are doing like raising rounds to buy spot ETH and whatnot. And basically, we believe the aim was to wash out retail positioning and liquidity to kind of accumulate more spot Bitcoin. This obviously then plays into that argument of that this cycle is different because too many of the wrong hands have too much buying power or spot BTC to dictate the price in their desired direction. We will be covering this later in the video. So what did we mean on the previous slide where we said that there is so much retail froth? Well, to be honest with you, it all starts with us being in a gamble economy. The macro economy is weakening at a rapid rate in Western civilizations. Job market and earning a decent wage to perform alongside the inflation rate is now harder than ever, especially with AI coming in now and more or less large companies doing mass layoffs. With perps or futures trading being made more readily available through perp dexes, on-chain perps, non-KYC exchanges, and many more, it allows any old retail trader to come into the market, deposit capital, and size up with little to no concept of risk management and take trades. This allows people to make levered bets on propped up VC alts with a lot of fake liquidity in the books, as we saw play out on Friday. We will cover this later in the video as well. But more and more people are now willing to gamble or take risks due to being cut out of the wealth effect and wealth divide. So, for example, we can see now that like so many people are being laid off from jobs. People aren't earning enough to perform alongside the inflation rate. Goods are becoming more expensive. Therefore, people are willing to take a larger gamble now to in turn make money. For example, now see the introduction and boom of prediction markets, the increase in people buying and trading crypto, and a huge increase in online gambling, especially in the West. Right, so just supporting this using an example of order flow from the Sunday after the crash. Basically, what order flow will allow us to do is to zoom into price rather than just looking at a chart and trying to assess who's moving price, what's moving price. Order flow allows us to, alongside the chart, see how price is moving and judge the health of a move and just see who really is driving price. For an example here, looking at the chart, we can see that we haven't just got price, we've got aggregated spot and future CVDs, or cumulative volume delta, which essentially aggregates volume and data from a bunch of exchanges to then see the total spot volume and the total perps volume for when price moved a certain percentage. And then in conjunction with that, we've also got open interest, which is the amount of perps or futures positions aping. And we've got ours set to notional BTC instead of dollar value. And then also we use funding rates, which is essentially the cost of doing business or the price you kind of pay to the exchange for running a perps position. So with Friday the 10th of October being the largest liquidation event ever in crypto with well over $19 billion in positioning carried out, we can see that retail was still willing to gamble on the Sunday. Sundays are typically more illiquid. This is because traditional markets are closed. Institutions can't really bid because obviously the American markets are closed, or that goes for American institutions only. So really and truly any spot TWAP or running bid that would carry through New York session from things like ETFs or treasury companies or DATs aren't able to bid, which leaves the floor open and books a lot thinner for spoofing from like Coinbase and Bybit and whatnot. So as we can see on Sunday, we saw spot bid start to really drive price, and after Friday's action, well, we can't really blame retail for assuming that the bottom was in, and just under 10,000 notional BTC worth over $1 billion in futures positions aped just on this low time frame illiquid Sunday move. This is what we mean when we say retail froth and that we say we are in a gamble economy. So what did insiders gain from the largest crypto liquidation event in history? Well, as a summary kind of or what happened, well, they were able to carry out retail traders for their liquidity and their positions. It was the only way for the kind of insiders and institutions to fill their stink bids while creating mass fear. And the only way to do this was by hard nuking spot BTC into illiquid books with algos turned off. They were able to take out all the retail froth and rotate capital back into the hands of the select few, obviously the people that were the insiders and behind it. So Donald Trump's team, market makers, exchanges, and etc. And this is a clear example of the repeat vicious cycle we've been seeing throughout the duration of this cycle, which is essentially spoofing spot books by Binance and Bybit and the market makers that operate on them, to bait and carry out perps by dictating bias with spot bids and offloading, and then mean reverting to earn the margin from overlevered positions and buy back spot Bitcoin cheaper. If you didn't really get that, we'll explain this better later on. So now that we know why it happened or what was the objective of the insiders to kind of force price down that low and that fast, let's get into the timeline of the events of Friday the 10th. So we started the day with the hyperliquid shorter. If you're not familiar with hyperliquid is essentially a perp DEX or a perpetual DEX decentralized exchange, basically meaning you can connect to this exchange with a hot wallet and no KYC and basically trade futures or perps without anybody being able to directly track who you are. Obviously you can track it on chain when you link it to a KYC exchange and whatnot, but just looking at this for face value, there is no way to kind of tell who this is. However, we know the shorter obviously had insider information. To put $75 million worth of margin on a 10x cross short is brave. You wouldn't do that unless you obviously some sort of exchange that's maybe going delta neutral or hedging, or maybe you're a large person just hedging or whatnot. But regardless, you had to have known something. The shorter on Hyperliquid was short just under 750 million notional BTC from the start of Friday on 10x cross margin, and that was worth over 6,100 notional BTC at the time. And coincidentally, in conjunction with this, the word tariff was being thrown around again as TradFi nuked as New York opened on Friday. As we can see here, when we compare the S&P to the Nasdaq from Friday, we can see that price was trading up during pre-market through Asia and London. However, as soon as New York opened, Trump started to hint at putting tariffs on China again, after we haven't really heard the word again too much. And all of a sudden, the stock market just nuked. Obviously, we know that TradFi and suits don't like uncertainty. So what's the natural reaction? To start de-risking until we get more clarity. And obviously then in parallel with this, we had spot gold just going absolutely crazy. Right, so also looking at data or screenshot that we took from AgaTrade on the day of the event, we can see that obviously this is where price started at the daily open, and we kind of worked our way all the way down, and obviously price collapsed. But obviously looking at AgaTrade and looking at these CVDs, or as we mentioned earlier, cumulative volume delta, we're able to see who was moving price. As we can see at the top here, where all of these kind of CVDs, these are perps or futures books, and anything below KuCoin here is a spot book. As we can see, most of the weight was carried out on Binance. This would have been a mixture of shorters, but again, majority of these downward move from perps would have been long liquidation cascade. Obviously, as longs are kind of market aping short to buy out of their longs, that's why CVDs were spiking so aggressively to the downside. And we can see that Binance had just been aggressively offloading continuously all the way down through the weekend as well. As we know though, it's not just Binance, it's the market makers that operate on them, such as Wintermute, that would have turned off their algos and allowed price to just free fall. So obviously there was some insider information going on here as well. And it's quite weird that Trump, throughout that small time period, started to talk about issuing CZ a pardon from his crimes. Right, so from the Friday, we can see that different alts went to different prices across different exchanges. This is due to different order book depth and liquidity across different exchanges. Well, using SUI as an example here, from the Friday, on the left we have SUI, the perps pair on Binance, which went to a daily low of 57 cents. And on the right, we have SUI Spot on Mexi, which went to a low of $1.40. Typically, your largest CEXs like Binance, Bybit, and Coinbase, their books are a lot thicker. Well, what do we mean by this? Well, quickly, we just mean that they are a lot more liquid, and you're less likely to get slipped if placing a market order. However, Binance, for a lot of alts, went lower on most alts than smaller exchanges like Mexi or Woo or Blowfin, or basically these smaller kind of CEXs that you can trade on. Why is this? Well, this kind of proves our point that the market makers that operate and provide the liquidity to these large exchanges, specifically Binance and Bybit, had turned off their algos, had to be due to inside information and whatnot to allow price to free fall. Why is this? Well, it decimates alts and carries out a ton of perps positions that would have been running on these coins. Prices that otherwise wouldn't have got filled, as proven by taking a look at Mexi as just one example here, where price went to a daily low of $1.40, and price on Binance, which typically would have held up a lot better than all these other exchanges, went significantly lower. And this is just one example because it carried out over most altcoins out there. So just briefly covering before we move on what we were talking about in the last slide, what are order books? Well, order books are a real-time list of all buy and sell orders for an asset, showing where traders are willing to buy, sell, and at what prices. Some exchanges have thicker and thinner books. Thicker basically means there's more liquidity to provide fills at a current price, basically meaning there's more buy and sell orders or bid and ask, and this often provides a tighter spread when executing market orders, meaning better fills and you're less likely to get slipped. Small exchanges often have thinner books or less liquidity, so if you were to slam market buy on BTC on Binance and a small exchange like Mexi at the same time, it's highly likely that you're going to get slipped more on the smaller exchange and get filled at a higher price. This briefly goes back to what we were talking about on the last slide, where Binance should have typically held up more over your smaller exchanges, but most alts went lower on Binance than they did on most other exchanges. Hence basically rotating into the argument that market makers turned off their algos to take out a ton of perps positions. prices on Binance went significantly lower, and people that even were trading on 2x ISO margin and that were having them as running swings and just taking funding as a cost of doing business and were up significantly on UPNL would have even got carried out. Right, so let's just briefly cover market makers. What are they and what do they do? Well, market makers are the players who keep markets moving by constantly buying and selling or providing liquidity into books to facilitate trades and orders. Wintermute is one of the biggest examples in crypto, and they execute on Binance, but there are other large ones that also execute on Binance and Bybit typically. They have live trading algorithms to make sure they remain delta neutral. Basically means that they're not long or short, but all they're doing is profiting on the spread, which is the difference between bid and ask. Binance definitely got wind of the trade that was coming from the Trumps, talking about the 100% tariff announcement that came out just as market was closing. Spot CVDs were nuking through New York session and carrying out ton of perps positions prior. Wintermute execute on Binance and would have turned off their trading algo that keeps prices stable, allowing one of the most liquid books in crypto, which is BTC on Binance, to freefall and cascade, dragging down a ton of alts with it. The same story here, but also for most altcoins. Many coins erased years of gains in 5 to 10 minutes as these algos were turned off. Really and truly, this goes to show how fake and propped up the alt market really is for most coins. Combine the removal of running bid algos from market makers with long liquidation cascades that were repeat happening and that were essentially market selling out of their positions, also known as covering. And this allowed price to tumble in seconds towards more and more resting stops with no TWAP or bid to support price in the books. Right, so just using an example here that we've quickly drawn up just to visualize what we were talking about. Say that price is basically trading in this small range here. Market makers or liquidity providers are providing resting bids in the book so that basically every time price reverts for fills, the selling is absorbed by the market orders, keeping price in this sustained sort of range, not allowing it to go lower because the bid orders are enough to fulfill the sells and allow price to reverse. Great. But however, take Friday as an example here where the algos turned off. This basically meant that price had no floor to catch it essentially, and price was able to freefall. Right, so just leading into a summary here, this then all plays into the argument that this cycle is in fact different. This cycle is no longer PvP, it's no longer you versus me in the books. Institutions and insiders have now changed and now dictate the whole ebb and flow of the market. All the low time frame moves, as we just explained as well, during illiquid sessions are often dictated now by spot books on Binance and Bybit, or the market makers that operate on them. They do this by spoofing orders to bait perps into trades and then remove their floor. And by doing this, they earn the over-levered margin from wicking out those stops and are then able to buy back the spot BTC they use to spoof the books for cheaper, increasing their buying power and allowing them to rinse and repeat this cycle. This then plays into the argument as well that too many of the wrong hands have their hand in the market, and they all have enough buy pressure or liquidity to dictate the price where it suits them. This is no longer a retail level game, and Friday the 10th just shows how unregulated the books really are. So just a summary here, or TLDR, too long didn't read. Tariff headlines were being thrown around New York session, causing TradFi to aggressively sell off throughout New York session. Around market close, the tariff figure, which was 100%, was released and futures kept nuking after New York closed. This in fact did kind of mark the exact local bottom, but we're still struggling to break back into an aggressive uptrend. Hyperliquid Shorter was short over $700 million notional BTC on 10x cross pre-event. As it was on a perp dex, it was anonymous, but obviously the running belief is that it was someone in the Trump team or someone in the White House. Market makers then turned off their algos and spot books nuked hard. BTC dropped over 15% from the daily open. Most alts were able to erase years of gains in just under 10 minutes and taking out billions in margin and UPNL that exchanges then of course didn't have to pay out and allowed them to earn that margin. Sunday came and DJT, or Donald Trump, began to ease off China slightly. No doubt him and the other insiders bought up spot coin aggressively during this cascade. This obviously was some sort of plan to carry out retail from what is now considered a government level game in crypto, which is now kind of, I guess you could say, the billionaire's playground due to the level of regulations. Right, so that is the end of the video, everyone. We really hope you enjoyed, and we really hope this allowed you to gain some more clarity on what exactly caused the liquidation cascade on Friday the 10th. We hope to see you in the next episode.
See you in the next episode. Magnus, out.